Hey guys, welcome back to another Stock Society video. Today we're going to be talking about investments in the stock market. Today's video is presented by Gore Financial Group. Topics covered in today's video are stock brokerages, how to determine investment goals, and investment strategies. Let's first start off with stock brokerages. A stock brokerage is a financial institution that processes buys and sales of stocks, commodities, and other forms of assets in the public market. You've probably seen an example of a stock brokerage once or twice if you've ever researched how to invest in stocks. Screens like this are mobile versions where investors can place a buy or sell at the click of a button. Since stock brokerages have an important responsibility of placing buys and sales in the open market for you, there are a few things that you should take in consideration before selecting a stock brokerage. Some of these considerations include spreads, which are the difference between buying and selling prices. And as a side note, spreads are how brokerages make their money, so high spreads can lead to lower profit margins over time. Another consideration is the type of accounts offered by the brokerage. Cash account, margin account, IRA, make sure the brokerage fits your personal needs. The last consideration is minimum deposit amount. Some brokerages require $10 for an initial deposit, others require tens of thousands. Some examples of good brokerages for beginners are TD Ameritrade, Webull, and Charles Schwab. Now let's move on to our second topic, determining investment goals. Investment goals vary from person to person. However, age, annual income, savings, risk tolerance, and investment horizon are just a few of the several aspects investors should consider while determining investment goals. Let me give you an example of how investment goals differ from person to person. Investor number 1 is single, 25 years old, a grad student, $50,000 annual income, and $5,000 in savings. Because investor number 1 is still in grad school and hasn't established their profession as of yet, their investment goals are more than likely going to be building an asset portfolio with high risk tolerance. This investor could be looking for a higher risk tolerance because of still being young in age and because the stock market is at a good buying point. Investor number 2 is married, 40 years old, a software engineer, $175,000 in annual income, and $40,000 in savings. Because investor number 2 has already established their profession, has married with 2 household incomes, and has a good amount in savings, their investment goal will more than likely be to conserve their assets with low risk tolerance. This investor could be looking for low risk tolerance so they can send their kids to college. These are just 2 examples of how investment goals differ because of age, annual income, savings, marital status, etc. Now let's move on to our last topic, investment strategies. Just as a side note, your investment goals will inevitably determine your investment strategies. Now let's say you're looking for a long-term investment strategy. A long-term investment strategy in the stock market requires time, patience, and a diversified portfolio of stocks to prevent drastic losses. When it comes to developing a long-term strategy, dividend stocks and large-cap companies should be a primary focus for low risk tolerance. On the other hand, when developing a short-term strategy in the stock market, it requires an increased amount of capital, higher risk tolerance, and a dedicated strategy to prevent losses. Options contracts are the primary way investors seek short-term gains in the stock market. However, as a beginner, you should understand that options contracts take on more risk in the market. Thanks for watching today's video. Make sure to hit that subscribe button and view the description for all other investment resources.